Hey guys, welcome to the Trade Genius Podcast. Bob and Phil here as always. Guys, we have identified what is likely going to trigger the next big recession, if not depression. Do not miss this video. Let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. All right, Bob, before we get into today's topic, maybe a little recap on today's price action. I know we had that big, ugly, bearish engulfing sell candle that printed. And then today, people are a little confused because we didn't necessarily roll off. However, I think the nature of today's price action was an inside bar, and maybe you can expound on that a little bit.
Yeah, two things. One is we had a bearish engulfing yesterday, which is actually unusual, Phil, for a Fed week. Usually what you expect is we were up on Wednesday. You'd expect Thursday actually to be down, and then for them to lift it into the close on Friday to balance the books. We didn't do that. We actually gapped up on Thursday, and we created a bearish engulfing pattern, what's called a dark cloud cover pattern. Okay, so there's two invalidations to that pattern. One is, did it close above the halfway point of that candle? The answer was yes, barely. But the other point is that it has to make a new high to invalidate it. And so now we have to wait. Now we have a range here. You know, the Thursday low and the Thursday high is really the range that we got to watch now. If they break above that range, then the crack up boom is still in progress. If they fall below that, then we start taking out some other stops, and then we're going to go down and pipe fill some of those gaps down below. And in August, Phil, you were saying we looked at seasonality, is that seasonality and volatility seasonality actually supports the move down. But in the meantime, don't do anything until one of those ranges breaks. Don't deploy a lot of capital one way or the other. Just wait for it. Because we had some really weird action today. The shippers are still grinding. Energy's still grinding, which is not good news. But also we learned something else, Phil, too, is that the market doesn't like over 4% 10-year.
No.
And the Japanese don't like the Japanese yen under 138. So now we kind of have some stakes in the ground to watch to give us a clue as to which direction things will go. And I'll throw it back to you before we talk about today's subject.
Yeah, and I think today, inside bar is usually a day of digestion, consolidation, and we had a big policy shift from the Bank of Japan after decades of accommodating. They're signaling that that's coming to an end, but they've been a little ambiguous on what exactly that means. So I think the market's trying to figure out, okay, do our carry trades change? Is this all coming to an end? And so you had a big sell late in the day off of that, and I think today was consolidating. And like what you said, it's a lot of times that's market makers balancing the books. If there was another large sell program, then we wouldn't have seen that today. But today was a day of consolidation. So I think the market's trying to sort out what this means from the Bank of Japan going forward, because make no mistake, it's a big policy shift. But some of the reactions we've seen in the Forex markets and things like that, and the Treasury markets, has been a little odd. So I think everyone's trying to figure out what exactly that means. So I'm going to go with what you said, either breaking the high of the bearish engulfing candle or the low. And that's the movie that you're going to go with for the foreseeable future. Beyond that, we do have seasonality that favors a rise in the VIX, the volatility index, which is bearish for markets, as well as price action in the indices are typically down for the first couple of weeks in August. So, and then the last thing is the Treasury issuance from Yellen. She's been fighting what the Fed's been rolling off. That comes to an end on Tuesday when she issues her final issuance of short-dated T-bills. And that's been bullish for the market because the overnight repo market has been drawing down, which is positive for the market, been drawing down, absorbing that issuance. So when the repo markets are drawing down, it's bullish, especially when it comes to absorbing short-dated maturities. It's bullish for the market. So even though on net liquidity is dropping, the Fed's still rolling out their balance sheet, you do have these short-term effects. It should be temporary, and that stops happening come Tuesday. Going forward on Tuesday, if that's really all that was fueling this pump, right, then we should start seeing the market start to see some red days going through the first part of August. So I think that's where you have to just leave the market, and you'll have more information. Basically, we need more market generated information, and we'll get that by the end of next week.
Just remember, guys, $6 trillion she has to roll in the next 15 months. Where the hell is she getting that money? Okay. So it's gonna come out of the height of equity markets because they've already maxed out domestic purchases. So just bear that in mind. Now, there's one thing for sure that's really going to struggle is real estate. And I'm going to set this thing up here, Phil, is that real estate has two components to it. It's what I would call the actual production of real estate and then the servicing of real estate. And we're looking at 15 to 16%, 15, 18% of GDP is real estate. 3 to 5% of it is in construction, and the rest is in what they call services. And the environment that we're in today, a lot of people are giving us this narrative, Phil, that, hey, most people locked in their loans at a low rate. Mm-hmm. So what's the big deal with Powell raising? Well, this chart we're throwing up here, this first chart, is showing you the maturity of open loans over the next 2 years, this year and next year. And it's mind-bogglingly high. All this gets repriced from 2 to 3% to 8 to 10%. So you know what's going to happen, Phil. Either they're going to eat it, or what's really happening now, they're walking away from these loans. They're either going back to the bank and they're going to try to rent it out at a lower rate, because they won't be able to, or sell it at a bargain, or they're going to sit on these properties like we did before and have ghost cities for a while. And it's not just Class A space; it's everything, Phil. Everything. Who's going to absorb that? If if you're an investor, you're going to sit there and have a really hard conversation and say, you know what, it's easy for me just to walk away and be with the crowd again, just like in 2007 and 2008. This one will leave you guys speechless. There are more homes, there are more realtors, registered realtors in the United States than there are homes for sale.
Yeah, that's pretty wild. Now, I mean, we knew that it would be tough go for realtors, but that statistic, that makes you pause.
And which is just amazing to me. And, and where I live in California, real estate is a blood sport, right? So, it goes up there with baseball and football. And these people make a lot of money, and the average house selling out here, is $350,000. They're picking up $9,000, $10,000 checks every time they flip a home. And some of these homes out where I live are $5, $6, $7 million. And I personally know two people that are in high 6-figure, low 7-figure incomes that have sold nothing, Phil, nothing this year. Market is stone cold dead. Amazing.
Yeah, I think across the country, sans a few markets that are bullish with not low inventory, but that still have some buyers coming into them, relocating from other areas. I think most market segments are seeing the same thing right now, and realtors are just. I know that I heard one feedback at a realtor conference, and they just said it's a bloodbath. Like everyone's just hurting year over year. Commissions are just down hard. Some of the biggest drops they've ever seen. So it's a big problem across the board. And that's going to contribute to unemployment too, right? You get a wave of realtors that are going to be unemployed, and that kind of segues into our employment stuff, which is this next chart here, and earnings versus home prices. Another reason why you're going to see probably a continued stagnation in the volume of home sales is the fact that nobody can really afford homes now because they're priced 30% over your typical home to income ratio. Okay, that's one. Two, like you said, everyone's locked into this okay corral standoff. They got low interest rates. And you got people that can't afford homes, especially now with 6, 7, 8, 9% interest rates that are coming with home loans. Because that's the other thing too, people have to realize, as the Fed rolls off MBS, mortgage-backed securities, right? So if you look at the symbol is MBB. If you look at MBB, that is the MBS, or the mortgage-backed securities ETF. That has an inverse correlation with the interest rates for home mortgages, more so than they used to say it was all about the 10-year. It's not so much anymore. It's about the MBS. So if you look at the MBB, the Fed is going to start rolling off more MBS. They've really been standing off from that, but they've indicated that they will get back to and increase their MBS roll-off. That's going to put pressure on mortgage rates. So that's why I think we're going to probably see 9, you could even see 10%. It wouldn't surprise me at this point. But imagine now you have this chart here, Bob, and you got house price index in purple going just straight up in the air, and wages have no chance of catching up here.
Well, the other thing too, Phil, is then add on to it the change in the, this is just the cost of housing. It's not the cost of buying the house. So you have now with the mortgages popped even higher, it's just unaffordable for most people. In fact, the MBS just, mortgage-backed securities, the government just put out a note that said foreclosures and bankruptcies and delinquencies are increasing, which is unheard of in real estate because most people can flip their house off. That means people they can't afford the home anymore. So it's a big problem. And this next chart this is the one that people really, and the reason why we titled our video the way we did. You got going into the rest of the year, you got the automobile market will contribute 0 to GDP. Okay.
Right.
The only reason why it was positive in Q2 was there was a 50% increase in automotive contribution to GDP, which gave it a 2% bump. Real estate is sitting at 15-18%. And I said in the beginning, two components of it. So the home building push that they did was these guys are trying to finish these homes, getting them sold. They're not going to be bringing on new housing supply in the country going forward. So you're going to see a reduction in what they call the investment end of this. Commercial's dead. We have people in the industry that are part of our service and you can't get financing. Commercial, multifamily, nothing. Okay.
Right.
Residential only because it's supported by the federal government. Do you have any kind of activity there at all? But what people don't realize is that it's more than just realtors that lose their job. And most of them don't show up in the unemployment report because they're 1099s. But people that work for title companies do. People that work for escrow companies that do. People work for inspection companies that do. People that work at Home Depot do. People that work for the remodeling or I got to sell my house, I got to fix this. Okay, all that is gone, Phil. And so, a definition of a recession is 2 consecutive negative GDP prints.
Right.
The definition of a depression is either 3 years of negative prints annualized or a 10% drop in GDP. And so, we got to be open into the case that we're going to see a negative 5% to 10% GDP print here over the next 12 months because we're freezing up the two biggest contributors to GDP in the private market.
Yeah, and also this chart here is the percentage of GDP for housing, mainly residential. What's not on here is commercial real estate, which is in a far worse situation, essentially not stalling but crashing. That's 5% of GDP. That's not on the chart here, but you can look that up online. It's 5% of the GDP. So you really have a lot of headwinds for GDP. Somebody asked, GDP came in positive this last report this last couple days ago, but as I was saying, there's a very lagged effect. And that's why a lot of times you're not getting confirmation of a recession until it feels like you're in a recession. And that's because, you're about a quarter or two late when the numbers finally confirm what you're seeing in your day-to-day life and what people are seeing. So I think this is a huge critical factor. This is very much like the 07, 08, 09 situation where you have a run up, but that it's unsustainable and that there's a credit event brewing. That's what basically the Big Short movie was all about. The credit event was brewing, and I think we have another credit event brewing, and I think that's why the Fed is not being more hawkish than they possibly could be, and I think that's why they're not trying to roll off the balance sheet as much as they could, right? They could easily double the rate at which they roll off their balance sheet. There's something about the Fed that tells me that they're still very leery about the fragility of the banking system as a whole, and so they're kind of in this weird spot where they can't go overboard too much, but then again, if they don't get super hawkish and the market has this kind of like this rise built in because people keep compounding these calls. What's happening now with the market in the 0 DTE option game is exactly what we saw with, I think it was SoftBank, right? They were running up calls when they realized the Fed was going to be easing a bunch of money. They said, heck, we can leverage that, right? So it's interesting because they're leveraging that same approach, but the fact of the matter is that the fuel for that approach, which I believe was the short dated maturity issuance, which the Treasury's never really done a dense short dated issuance that I could see like they did in the last month and a half because if you notice, right, as soon as the debt ceiling was raised and she was able to reissue debt, market basically lit a fuse, right? So that's why I think it was mostly due to that short dated issuance. And the reason why is because they can take those T-bills and use them as collateral and leverage them. and the leverage in the system has been cranking up, so it ties in. But if you're going to do that call game, you have to have an inflow of capital to be able to do that. So I propose that capital flow ends on Tuesday, and that call game gets more difficult, because you saw what happened at the end of that regime in 2021 when the Fed turned off the spigot. That game ended. So it works when you have a positive flow of capital flowing in this case it was a T-bill issuance. Without that though, it basically implodes. It's a house of cards and it falls in on itself.
Yeah, and look, guys, short term, I think the market wiggles here, but long term, I just don't see it. The United States GDP, we're 60% services, okay, 40% basically, 35% government, 65%, but most of our GDP, out of that, about 75% or 80% of it is services versus manufacturing. And so, we have an issue here where you're going to go from have to haves to nice to haves, and you're not going to buy the nice to have stuff. And we're already starting to see that bifurcation. And when that starts to roll off, then it starts to snowball. And look, we're already there. So it's just, a matter of time. And you know what? And the unemployment rate, it doesn't have to get much higher. Okay. Just because people are rolling off the employment books as they retire. So it's, and what are we talking about? Retiring and disability, 5 million people on disability in the country, Phil. Unheard of.
Right.
So even if unemployment doesn't move much, you're going to get this deadening effect because of where the money is going to be spent on what it's going to be spent on. And it's going to be pretty nasty. So again, caution, if you're in this industry, we don't have to convince you of this. If you're in the auto industry, who's buying these cars at average of $750 a pop? You tell me who all your friends can absorb that. And then you're going to know where this economy is going to go.
I totally agree. We probably have a mean reversion coming, and it's probably going to be credit event driven. And most likely, I would think it starts with the commercial real estate and then segues over into the residential real estate markets. And it's weird because we've been down this road before and it's not pretty. So enjoy the bid while it's still here, because I think we have some serious headwinds going in. And I think the data will confirm that as we move forward into Q3.
Yep, I agree. Thanks for listening, guys. We're going to have a really interesting topic for you tomorrow. So stay tuned.
All right, guys. Thanks for watching. We'll see you. Bye-bye.
Trade Genius.